Hey everyone, and welcome. If you've ever asked yourself, what's the absolute best way for a total beginner to start investing? Well, you've come to the right place. Today, we are going to break down a pretty fascinating 4-year experiment that set out to answer that exact question. This is the $1,000,000 question, isn't it? Or, well, the $100 question. How do I invest my first $100? It's a question that holds so many people back, but today we're going to get a real answer by looking at the hard data from 5 totally different investment ideas. So here's our game plan. First, we'll go over the rules of this little challenge. Then we're going to pit individual stocks against the entire market. After that, we'll check out some tangible assets, real estate and gold. Then we'll throw in the wild card, crypto. And finally, the moment we're all waiting for, the final results. Let's do this. Okay, so picture this. 4 years ago, an experiment kicked off. The idea was simple. Take $100 and put it into 5 completely different types of investments. Then just wait. The goal was to find out, once and for all, which one performs best for a beginner. Now, to judge these fairly, we're going to use a scorecard. We're looking at 5 really important things. The learning curve. How hard is it to get started? Passive income. Can it make you money while you sleep? Tax efficiency. Are there any nice tax breaks? The risk level. How likely are you to lose your shirt? And of course, the big one, the final results after 4 years. All right, let's dive into our first matchup. This is a classic. Individual stocks versus the market as a whole. The big question is, are you better off betting on a single horse or on the entire race? First up, we've got individual stocks. This is what most people think of when they hear investing, right? You do your homework, find a company you really believe in, like, say, Apple or Samsung, and you buy a tiny slice of it, hoping it takes off. But here's the catch. Picking winning stocks has a really steep learning curve. You can't just throw a dart at a list of names. To do it right, you need to be willing to dig deep into financial reports, understand the leadership, analyze the brand. It's a serious time commitment. And that brings us to the risk factor, which is also high, very high. I mean, think about it. If you put all your money into just one company and that company goes under, poof, your investment could be gone. It is the definition of high risk, high reward. So, what's the alternative? Well, that would be index funds. Imagine buying a single basket that holds a tiny, tiny piece of the 500 biggest companies in the US. That's basically what an S&P 500 index fund is. You're not just betting on one company to succeed, you're betting on the American economy as a whole. And the beauty of this approach? The learning curve is incredibly low. Why? Because it's a passive investment. You don't have to pick a single stock, you don't have to read a single balance sheet, you just buy the fund and you're done. It's pretty much designed to be a set it and forget it strategy. And this slide just perfectly sums up the difference. With individual stocks, all your eggs are in 1 or 2 baskets. Your risk is concentrated, so diversification is low. With an index fund, your risk is spread out across hundreds of companies. Your diversification is high, which makes your overall risk much, much lower. Okay, next up, let's talk about investing in real physical things. Assets you can theoretically touch, like property and gold. First in this category is something called a REIT, which stands for Real Estate Investment Trust. Think of it like this. You and a bunch of other people all pool your money together to buy big properties, like apartment buildings or shopping malls. You get to own a piece of the real estate and collect your share of the rent without ever having to be a landlord. So where do REITs really shine? Well, it's their potential for passive income. See, they're legally required to pay out at least 90% of their taxable income to shareholders. They have to share the profits. This makes them an absolutely fantastic tool if your goal is generating a steady income stream. And then we have gold. For literally thousands of years, this has been the ultimate safe haven. When the stock market gets choppy or inflation starts to creep up, a lot of investors run to gold as a way to protect their money. But, and this is a really big but, here's the most important thing to understand about gold. Its passive income potential is 0. A big fat 0. Gold doesn't pay you anything. It just sits there. It's what's called a store of value, which means you only make money if you can sell it for a higher price than you bought it for. All right, it is time for our wild card. The one everyone's talking about, the most volatile, and maybe the most explosive asset in our entire challenge, cryptocurrency. Is it all risk, or is there a real reward to be found? At its heart, crypto is just digital money that operates completely outside of the traditional banking system. Some people see it as the future of finance. Others see it as pure gambling. And, the truth is probably somewhere in the middle. Now, when we look at our scorecard for crypto, two things just jump right off the page. First, the risk is rated very high, and they are not kidding. Prices can soar or crash in the blink of an eye. And second, its tax efficiency is rated poor, mainly because it's tough to hold it in those tax-friendly retirement accounts. This is the wild ride for sure. So, there we have it. We've met the contenders, we've seen their strengths, we've seen their weaknesses, and now it's time for the moment of truth. After 4 years, which one of our $100 investments actually won?
Okay, the results are in, and wow. In last place, our individual stock pick, Samsung, a huge, safe blue-chip company, actually lost over 32% of its value. Ouch. In fourth, our REIT delivered a decent 10.5% gain. Not bad. Third place goes to gold, the classic safe haven, which returned a very solid 40%. Coming in at a strong second place is the S&P 500 Index Fund, turning our $100 into almost 180. That's nearly an 80% gain. But in first place, by an absolutely unbelievable margin, our $100 in Bitcoin exploded to over $650. That is a 550% return.
This bar chart really puts it all into perspective. I mean, just look at that difference. It is the perfect picture of risk versus reward. Bitcoin delivered that mind-blowing return, but it came with that very high risk we talked about. The index fund, on the other hand, gave us fantastic steady growth with way less drama. So what is the big lesson here? Well, while that giant Bitcoin number is super tempting, the real takeaway might be how well the simple index fund did. It shows that whether you're a gambler or a slow and steady type, the single most powerful tool you have on your side is time. The magic of compounding means that starting early, even with just a little, is the most important thing you can possibly do. We've seen the high flyers and the steady growers. We've seen the wealth builders and the wealth protectors. They all have their place. But the biggest lesson from this whole 4-year experiment is that the only truly bad decision is making no decision at all. So the only question left is, where will you start?